This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. Real Money helps you think through ideas for investing and trading stocks. Action Alerts Plus is a charitable trust portfolio that provides trade-by-trade strategies. Online, mobile, social media. We are TheStreet.com.
Triple-digit loss. The Dow falls sharply after yesterday's big move higher. We'll look beyond the volatility and get investment strategies for the long term.
Low-rate world. Who wins and loses with interest rates at record low levels?
And art gallery bust. Why a high-end art dealer is accused of selling more than just paintings. We have all that and more tonight on Nightly Business Report for Wednesday, April 17th. Good evening, everyone, and thanks for joining us. I'm Susie Guerin.
And I'm Bill Griffith in for Tyler Matheson all this week, and of course it's been a busy week.
Oh my God, and it's only Wednesday, and we've had big rallies and big sell-offs in the stock market. What a week. Well,
it was a busy day again for a third straight day. Susie, the session, we saw a triple-digit movement for the Dow, but today's stocks were on the losing end of the trade. A round of disappointing earnings reports before the bell, including results from Bank of America and Bank of New York Mellon, combined with tumbling energy prices, pressured stocks to give up most of Tuesday's gains. All 10 S&P sectors ended lower, with technology, energy, and financials seeing the biggest declines. The Dow was off the lows of the session, but still fell by 138 points, closing the day at 14,618. The S&P 500 was down 22. And the NASDAQ, hardest hit percentage-wise, down 60 points, dragged lower by shares of Apple, which for a time dipped below $400 a share today before closing at $402. That after one of its top audio chip suppliers, Cirrus Logic, hinted at a slowdown in production of iPhones and iPads. Meantime, Bank of America was the biggest drag on the Dow today, falling by nearly 5%, followed by a 3.5% decline for J.P. Morgan Chase, with a lot of the other banks following suit. Bob Pisani has more on today's action in the markets from the floor of the New York Stock Exchange.
It was another whipsaw day for the stock market that started ugly right off the bat. The problem is that key commodities like copper, aluminum, and nickel were again dropping, sitting at essentially 52-week lows, all on concerns about slowing global growth. Key commodity stocks like Freeport-McMoRan, Cliffs Natural Resources, U.S. Steel, and Peabody Energy all hit 52-week lows as well. And while commodity stocks like materials and energy suffered, there were also notable declines in industrials and in financials like Bank of America, which missed earnings estimates. And in technology stocks, tech bellwether Apple hit a new 52-week low on concerns over slowing iPhone and iPad sales. The markets staged a modest comeback midday, likely on word that progress was being made in the Boston Marathon bombing investigation, but again moved down toward the close.
The problem for the stock market right now is a simple one. The market's been in an uptrend all year until Monday. But now we've had two big down days, 2 days with selling on heavy volume. And that's calling into question whether there is still an uptrend in the stock market. That's relevant because trend followers are an important part of the market. And if they determine there's no more upside to the market, the uptrend could become a downtrend. For the Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And despite some wild swings in the markets lately, the Federal Reserve remains steady and upbeat. The Fed's so-called Beige Book survey of economic conditions around the U.S. showed moderate growth in all 12 of its banking regions over the past 6 weeks, with the overall economy getting a big boost from housing and strong auto sales. The central bank also said the economy performed better during March than the month's weak jobs report and the dip in retail sales would indicate.
But that report didn't do much to boost investor confidence today, and the market's gyrations have created confusion for investors. Do I stay the course? Sell, or is now a good time to buy? We turn to Sara Malik for guidance. She's the head of global equity research for TIAA-CREF. It manages $500 billion in retirement and other assets. Sara, thanks for coming here.
Thank you.
Welcome. I mean, this is a very confusing and nerve-wracking time for investors trying to navigate through all of this. So how do investors sort through all of this information?
Well, we're dealing with a lot of noise right now, and just this week we've dealt with a lot of volatility. Just China GDP came in below expectations this week. We also had to deal with a decline in oil prices, and earnings have started out quite rockily. So what we're trying to do is look through some of this noise and focus on finding stocks that can do well for the long run. An example of that are companies tied to the housing market, such as Realogy. Realogy is a company that owns some of the biggest brokerage platforms in the country, such as Coldwell Banker and Century 21. And they're going to do well as housing prices and transactions continue to do well.
So you're always looking for the mega trends. You're not looking for next week's opportunities. You're looking at the long-term overall picture. Do you feel housing is recovering? What about energy? Do you think the prices are generally headed higher or lower from here?
Well, commodity prices are suffering right now, and a lot of that has to do with some of the problems that China's having. GDP is coming in under expectations, and they're also dealing with inflation bubbling up. So we're focusing more again on companies that have their own levers to pull. And one company we like a lot is Time Warner. This company is doing really well because they own great brands such as HBO, which has Game of Thrones, which is a great show. And they also have a great movie franchise with the Hobbit franchise coming out and the first movie doing over $1 billion at the box office.
Now, I understand you're not a real fan of technology stocks, although you have some in your portfolios. But when investors see these headlines about tech stocks are really hammered, or the news today that Bill was reporting about on Apple, that the stock is trading really low now, around the $400 range, there's this urge to say, this is a bargain, this is value, and should I buy it? How do you advise investors to examine and digest this information?
So technology companies are struggling right now because companies are reluctant to spend on technology because of macro uncertainties. There's also new structural trends going on in technology, such as cloud computing. And we're looking at companies such as Amazon that have a web services business and also can dominate the retail area.
You look globally. Where besides the U.S. do you like? I mean, Japan's been very aggressive with their monetary policy this year, and they've been a stellar performer overall as a market. I keep hearing about Mexico. A lot of smart money is going to Mexico right now for various reasons. Where do you like right now?
Well, we're looking for companies that can do well because of their global industry. So, for example, you can go to Europe and look in the global pharmaceutical sector. And Novartis is a great company there. Global pharmaceutical companies in general have great pipelines. Novartis has a great product outlook. Their products are already approved by the FDA, so that takes away a lot of the risk. And they have a rock-solid dividend yield at 4%.
Do you like them because they're a European-based company, or just they're in the right industry right now?
We like them because they're in the right global industry.
Is there some trend or something you're seeing out there that investors are missing out on? What should they be paying attention to?
We think investors should be paying attention to two powerful trends going on in the equity markets now that should support the markets for the long run. One is that stock correlations are declining. This means we're moving to a stock picker's market. You can do your homework, find the companies that are mispriced relative to their free cash flow that will do well over the next cycle. The second is equity inflows have turned positive. This is after 5 years of fairly negative inflows, and that's another data point that will support the stock market.
And a big guessing game right now is when the Fed will start to gradually pull back on all of the liquidity it's been adding to this market. When do you think that'll be?
Well, we're watching jobs to figure that out, and jobs claims have been a little bit rocky recently. The payroll numbers were also weaker in March, and we think as long as the jobless rate remains up at the 7.5–8% range, the Fed will continue to implement QE3.
Sara, thanks for coming by. Really appreciate it. Sara Malik of TIAA-CREF.
Well, some of the growth cited in today's Beige Book is being attributed to the Federal Reserve's low interest rate policy we were just talking about. But while those record low rates may be beneficial to some, they may be hurting others. This morning, for example, Bank of America became the latest company to highlight some of the difficulties of doing business in a low rate environment, servicing more loans, but making less money from them. Hampton Pearson has a report card of the good and the bad of the Fed's low rates.
The housing market, especially mortgage borrowers, have been the biggest beneficiary of the Federal Reserve's near-zero short-term interest rate policy that began in 2008. Close to 20 million mortgages have been refinanced since then. Mortgage applications and refinancings were up about 5% last week, and the Mortgage Bankers Association says the purchase index is at its highest level in 2 years.
Essentially, the Federal Reserve is putting all of real estate on sale, where homes are just incredibly affordable because of these very low rates that have been put in place by all of their efforts to push down interest rates.
Low interest rates are also getting consumers back into auto showrooms. New car sales could top 15 million this year as buyers replace aging vehicles and negotiate monthly payments that take away much of the new car sticker shock. Both consumers and businesses are paying off or refinancing debt. Consumer debt in the fourth quarter is now at its lowest level in a decade, approximately $70,000 per household. Corporate balance sheets are even healthier, with roughly $2 trillion in cash, an all-time high.
We've seen corporations clean up their balance sheets even more so. They've gotten rid of debt, restructured debt, and taken on a lot of cash to cushion themselves in case anything bad were to happen going forward.
The biggest downside, savers have been penalized.
Many savers, especially the elderly, have found that the interest that they used to live on is now falling short of paying their expenses.
While the policy of keeping interest rates low punishes savers, Fed Chairman Ben Bernanke says that's the trade-off for a stronger overall economy. For Nightly Business Report, I'm Hampton Pearson in Washington.
What happens next for interest rates is crucial for bond investors. A top regulator from the Securities and Exchange Commission warned that investors holding municipal bonds could see, quote, Armageddon if interest rates spike. The SEC's Don Gallagher also said that more high-profile bankruptcies like the ones in Stockton and San Bernardino, California, are also adding risks to the muni bond market. He's concerned that individual bondholders who believe they own risk-free securities could be, quote, wiped out as rates rise and bonds sell off.
Well, let's talk more about this. Joining us now to give her perspective on the muni bond market and how you should position your portfolio, Alexandra Lebenthal, back with us, President and CEO Lebenthal and Company. Alexandra, always good to see you. Thanks for joining us.
It's good to see you too, Bill. You know, I realized that you were my first television interview 20 years ago.
Yes, back when we were both in middle school.
Yes.
Sure. Let me ask you, there are a lot of assumptions in Commissioner Gallagher's reasoning about
definitely.
rates. The one that stuck out to me is that we would see a spike in interest rates at some point as the Fed begins to withdraw some of its liquidity. Do you think that's what's going to happen?
No, and there are a few things that I do have some concerns about that report. I mean, one, the term Armageddon gives me great pause. Second, the idea that muni bond investors would be wiped out also gives me great pause. And third, again, as you just said, the idea that investors would see this immediate spike in interest rates. And that actually just goes back to Sara, your previous guest, who said that, you know, look, we're not necessarily going to see interest rates and the Fed stop their easing policy immediately because we're still not seeing the activity from jobs, the economy show that the economy's heating up.
Right.
So, I mean, what should investors do, Alexandra? I mean, on the one hand, you always hear you can't time the market. So, should investors start unwinding out of these muni bonds, or is there still time to hold off?
Well, let's put your municipal bonds into a few different categories. First of all, most investors invest in investment grade and, in fact, high grade municipal bonds. So those are bonds that aren't the bonds that you've been hearing about in some of the California cities or some of the Rhode Island cities that have had some issues around them. So I would not be concerned as an investor about significant declines in value because of credit quality. Then you have investors who are investing in municipal bonds through mutual funds. Now, that's where you do want to have some concerns and think about your strategy when interest rates do go up. Because what will happen at that point is that individuals will start redeeming their mutual funds. The manager of the mutual fund will start having to sell bonds in order to meet the redemptions. The more redemptions that happen, the more bonds the mutual fund manager will have to sell. And it sort of becomes this self-fulfilling prophecy, the snowball that builds up that will drive bond prices down. And remember that in a mutual fund, you have no maturity. So that's where investors could see their principal value go down precipitously.
So are you arguing for an investor to hold muni bond funds as opposed to the individual bonds themselves?
I would argue for investors to be holding either individual bonds, or if they have enough money, to be investing in separately managed accounts where they have a portfolio manager that manages their account directly in bonds and buys and sells bonds according to what their needs are. Also, different from mutual funds are ETFs, where the fund manager doesn't have the cash dilemma that a mutual fund manager does. But one of the things that you want to do with your portfolio, if you're managing it yourself, or if you do have a portfolio manager, is look to manage it defensively. And by that I mean either have a laddered portfolio where you have bonds coming due every year so you can reinvest as rates go up, or have a short duration where you have calls, et cetera, that keep your maturity short.
Alexandra, I want to squeeze in a tax question. Any tax implications here? Because we hear that the Obama administration may want to put a cap on the tax exemption for some of these bonds. So is that another reason to clean up your portfolio now rather than wait?
Well, I don't know that it's another reason to clean up your portfolio, but it's certainly something to keep on the radar screen. Obviously, with everything that's going on in Washington, everything is on the table. And with each budget that comes out, there's this proposal that there would be a 28% cap on deductions, so that essentially no investor would be in a lower bracket than the 28% tax bracket. So that means that you couldn't essentially have all municipal bond income, tax-free income, that would put you in no tax bracket. And in essence, that would therefore be a tax on municipal bonds. Right. Mayors and governors are fighting this very, very aggressively. And each time they seem to get it out of the budget proposal, and then a new budget proposal comes out and it's back in. I do believe that ultimately state and local governments will be successful in arguing that this will actually drive the economy right back into recession, and it actually won't solve the greater purpose of helping the economy.
Always good to see you, Alexandra. You young whippersnapper, you.
Yeah, you too.
All right,
don't look a day older.
Yes, it's the makeup. Alexandra Leventhal of Leventhal and Company.
And coming up a little later in the program, one media company to watch this earnings season. But first, let's take a look at how the international markets closed today.
We begin our market focus with earnings after the bell tonight. American Express reported increased earnings per share, up 7% from a year ago. That was better than analyst estimates. Revenues also gained by 4%, but they were below expectations. Shares had been down before the close, losing 46 cents on the day, and then dropped further on the soft revenue results in after-hours trading. eBay also missed on the revenue while beating expectations on the profit, but eBay's guidance for the current quarter was below what analysts had been expecting. eBay lost ground during the trading day, down more than 1.5%, and then declined further on the cautious guidance.
Strong earnings from Mattel today thanks to increased demand for dolls, not just Barbie, but American Girl, Monster High, and Disney Princess. Cost-cutting and expense controls, thanks to expanded production in Brazil, also helped Mattel report better than expected quarterly profits and revenues. Mattel shares rose almost 2% to $43 and change. Abbott Labs also reported better than expected quarterly profits on increased demand for its nutritional and diagnostic products. Abbott shares gained almost 2.5% to $37. The stock, as you can see there, has jumped more than 18% this year.
Most of the blue chips were down, but Johnson & Johnson gained as a jury found that company not liable for damages from an all-metal hip product. More than 10,000 claims have been made against that device. J&J ended the day up more than 0.5%.
Well, as earnings season picks up, some big media and entertainment companies report their results next week. And those reports will reveal to Wall Street how Hollywood studios are reaching more consumers, especially in their living rooms. As we continue our series, Earnings Spotlight, Julia Borston tells us what investors may learn about trends in TV production and about TV watchers from Netflix.
One media company to watch this earnings season is Netflix. The first quarter was a big one for the streaming video giant. Not only did it launch its first original show, House of Cards, but its stock price has nearly doubled to $176, though it's still down from its July 2011 peak of more than $300.
The reality is I think they've really made tremendous strides over the last 18 months, restoring their brand in pretty short order.
The stock's gains come on confidence about House of Cards, unveiling the 13 episodes all at once. The $100 million investment in 2 seasons of shows seems to have paid off with critical acclaim and buzz. Though some analysts like Wedbush's Michael Pachter are skeptical, saying the likes of House of Cards won't have a long-term impact, others say it's a crucial move to secure Netflix's user base.
I think originals is very important for Netflix to get to that point where people forget about canceling because they feel like there's always something unique and really interesting coming.
With the launch of its new original show Hemlock Grove this Friday and a new season of Arrested Development in May, Netflix has made the shift from being a distributor to being more of a programmer, really competing head-to-head with HBO for customers as well as content. One of the key components to watch in the earnings report is subscriptions. Netflix forecasts it'll add slightly more than the 1.7 million subscribers it added in the year-ago quarter. We'll be watching to see how many people its new content lures and whether it helps revenue grow faster than expected. Another key area, international expansion. Netflix is evaluating several new markets, so Wall Street is eager to hear where it will launch next. And with rising competition from Amazon, which is investing more in originals and distribution rights, we'll see if CEO Reed Hastings addresses his rivals. Netflix reports earnings Monday afternoon. The company has said it expects profits from domestic streaming to, for the first time, surpass that from DVDs. We'll see if Netflix beats expectations as it did last quarter. For Nightly Business Report, I'm Julia Borston in Los Angeles.
And tomorrow we focus on retail and the one key earnings report to watch in that sector.
Still ahead, though, the story of an art dealer and an FBI raid. But first, a look at today's most actively traded stocks and how commodities, treasuries, and currencies also fared. An upscale New York City art gallery, a $6 million Trump Tower apartment, the Russian mob, and illegal high-stakes poker games that allegedly dealt in Hollywood stars like Leonardo DiCaprio and Tobey Maguire, as well as Wall Street titans and pro athletes. What do they all have in common? A $100 million money laundering scheme and 30 arrests. Bertha Coombs ties it all together for us.
Heli Namad has been making a name for itself in post-war contemporary art, but as FBI agents raided the gallery's Madison Avenue offices, federal prosecutors painted a very different picture of the high-end art dealership. Federal authorities charged the 34-year-old owner, Hillel Namad, with playing a leading role in a massive international gambling ring catering to celebrities and Wall Street professionals, and a money laundering conspiracy that stretched from New York to Kiev. Prosecutors say Namad laundered millions in illicit profits through real estate, including a 63rd floor apartment at Trump Tower on Fifth Avenue, which he could have to forfeit if convicted. Dealers who spoke only on condition of anonymity say they were saddened to see the gallery implicated in criminal activity. But they note that Heli Namad is not a member of the Art Dealers Association of America. One dealer saying the Namads are not known for fostering and nurturing artists as many other dealers do. but rather for building a collection valued at more than $1 billion through active buying and selling at major auctions in London and New York, where last fall, patriarch David Nahmad bought a Warhol portrait of Marlon Brando for more than $23 million. The gallery was closed today, but with the big money spring auction season set to begin in May, staffers put a sign in the window saying Heli Nahmad will reopen with an exhibition during the auctions. But before then, its owner will have to go before a judge for arraignment. In New York, Bertha Coombs for Nightly Business Report.
And finally tonight, Forbes magazine is out with its annual list of the biggest, most powerful, and most valuable publicly held companies in the world. And topping the list, 3 banks. 2 of them are Chinese. The Industrial and Commercial Bank of China is number 1, followed by the China Construction Bank. JP Morgan, General Electric, and ExxonMobil round out the top 5. That last one, Exxon, was tops in profits again, netting about $45 billion. Some other interesting factoids: Walmart, number 15 overall, had the most sales. Mortgage giant Fannie Mae, the most assets. And Apple, tied at number 15 overall, had the highest market value, at least for now.
Yeah, we've got a lot of earnings still to come here, and I'll be interested to see. We've had 3 days consecutively now where we've had triple-digit moves for the Dow.
So what's your prediction for
tomorrow?
tomorrow?
I mean, if a tradition holds, we'll have an update tomorrow, but you never know. Those earnings will be a big part of it, because that's it for tonight's Nightly Business Report.
I'm Susie Guerra. Thanks so much for watching.
I'm Bill Griffith. Have a great evening. We will see you back here tomorrow.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. Options Profits helps educate beginning and seasoned options traders. Action Alerts Plus is a charitable trust portfolio that provides trade-by-trade strategies. Online, mobile, social media. We are TheStreet.com.
I'm Susie Guerra with a Nightly Business Report news brief. Stocks suffered another triple-digit loss after disappointing earnings from Bank of America and tumbling oil prices. On Wall Street, the Dow fell 138 points, the S&P lost 22, and the Nasdaq was down 60 points. One stock dragging down the Nasdaq, Apple. It dipped below $400 a share briefly after one of its top audio chip suppliers, Cirrus Logic, hinted of a slowdown in production of iPhones and iPads. The Federal Reserve's latest Beige Book survey of economic conditions around the country showed moderate growth across the U.S. thanks to the housing recovery and strong auto sales. And Forbes magazine has listed the biggest and most valuable public companies in the world. Topping the list, 3 banks. 2 of them are Chinese. Be sure to tune into Nightly Business Report right here on your public television station.